This lecture will be a bit of an aside, but I'll try and do it very quickly. I just want to cover where money comes from in a traditional, government-based system. And I think this is important to understand when you're assessing things like Bitcoin. Because it gives you a point of comparison. You can see, we know how Bitcoin and ETH come into circulation, and so you can compare it to how governments work. And by government, I mean, sort of G20 countries, sort of, liberal democracy. So different countries operate different ways. But a country like Canada, how would it, how does Canadian dollars basically come into circulation? Where does it come from? Who's it given to? Those are the kinds of questions that I want to answer. The other reason I want to cover it in a Bitcoin course is that you hear it when you go out and talk to people about Bitcoin. Or you go to conferences about Bitcoin and things like that. You hear a lot of people talking about how it compares to usually not what the Bank of Canada does, but to what the Fed does in the U.S. They do the exact same thing. It's just that people tend to use more U.S.-based examples. So how does the Fed operate? How does Bank of Canada operate? I just want to give you like some indication of how it works, so at least you understand it and you have a kind of point of comparison. The other thing is you might think, well, Bitcoin not really working well as a money. We saw that in the last lecture. So maybe what if we did a different kind of cryptocurrency that worked more like how a central bank worked, right? Is there any lessons that we can learn? And so you'd have to look at the central bank mechanisms. And there are a breed of coins that we'll cover next called stable coins. And some of them do try to kind of emulate, they're kind of like a computer version of a central bank. They're called algorithmic stable coins. I'm not personally so crazy about how they work, but anyways, let's just look at how a central bank does. So the history of money is really long and interesting, and it goes back to different kinds of objects like sticks that would measure the amount of people's credit, and stones that were worth money and they were too large to move, and you can fabricate them and things like that. And so there is a very interesting history of money. Most recently, currencies that were backed by gold and that type of thing. But what we're going to do is we're going to skip to basically modern central banking. And it's important to note that currency itself didn't skip to modern central banking. So when modern central banking came in to existence, it came slowly. It sort of evolved, and there was currency that already existed. So it wasn't like it had to create brand new currency from scratch. It just sort of took over, the rules in terms of where money comes from in a system that already had money in it. So anyway, so we'll skip ahead, and you probably heard that central banks print money. There's even a meme, the money printer goes burr burr. This isn't really my conception of how it works. So the way it works in my mind is like this. So let's draw our central bank. And the central bank is actually a bank, right? It's literally a bank for other banks. That's why it's called the central bank. It wasn't always operated by the government. And in some countries, it's sort of quasi-government, like it's heavily regulated by the government, even though it might technically be a separate institute. But it was created by the banks themselves because they want to send payments. Well, there's a bunch of reasons, but one of the primary reasons was that they want to send payments back and forth between themselves. And so if I want to send you payment and we're both at the same bank, that's easy. My bank account goes down and yours goes up. I write you a check or I send you an e-transfer or something like that. Okay. If we're at different banks, there's this slightly more complicated tiered system that it goes through, but it effectively works the same way. Actually ends up at the central bank. But let's set that aside. Now, if you're a bank and you want to transfer money to another bank, right, it helps if you both have money at a common bank, right? Because then your balance can go down if you're the sending bank, and your balance can go up if you're the receiving bank. Okay, so that's how central banks work. So you have a central bank that you have accounts at the banks. They're owned by commercial banks, so like RBC, CIBC, TD, in Canada, and it could be other financial firms. It could be other central banks of other countries. It could get complicated here, but the main people here would be commercial banks. But it's not like you and I, right? Like the central bank, you can't just go in and open up an account. Now that might change with digital currencies, but as of today, it's true. Okay, and so you have a bunch of accounts, and they have a bunch of money. So your banks have a bunch of money. They have a bunch of money, in their branches, in their safes, in their ATMs. They have a bunch of money invested. They have it in the form of loans and assets and other things. But they also have some money that's parked at the central bank. And in fact, there's some regulatory requirements that say that certain percentages, they need to have at the central bank. And they have to maintain those balances, and sometimes they lend to each other at the end of the day to make sure that happens. Anyways, okay, so you have the central bank. Now, the other part, well, let me just start. Okay, so the central bank, when it wants to create money, it will actually do that. Okay, so it will, quote unquote, print money. And we have to think about who's it going to give it to. Okay, and so the answer is it's going to give it to the banks that have an account with it. Okay, so that's the destination of the money. And in this case, what does it mean to print money? Does it mean literally like print off paper bills and courier them over to the bank? No, it means that because these banks have a checkings account at the central bank, all it does is it goes into the checking account and increases the amount. Okay, so it's just a computer or something that does that. Okay, so it just puts the amount up. Now that should sound terrifying, right? Like the bank just increases the amount of money. And it also seems unfair because these banks are just getting new money. And so to make the system fair, the central bank doesn't just hand out money. It doesn't just create new money and hand it out. What it does is it says, I want something in return of equal value. Okay, so it wants to buy something that the banks have. So it could be any set of assets, but there's a set of assets called bonds. Okay, and I'll just draw it as a kind of dot. And so what the central bank will do is it will buy a bond back. Okay, now what's a bond? A bond is, it could come from anywhere, but the most common kind of bonds they buy are from the government itself. So there's a different branch of the government called the Treasury, and the Treasury is in charge of raising money. So whenever you have something like universal health care in Canada, someone has to pay for it. Okay, so where does the money come from? Well, it comes out of our taxes. So we pay taxes, and the government raises money through taxation. But sometimes they spend more money than they have. And if they spend more money than they have, it's called a deficit, because we're coming out of COVID now, and we've had large deficits in this country, and lots of countries around the world have increased spending. And so you have these deficits. And what does that mean? It means you're borrowing money. So what's the mechanism for borrowing money? Well, what the government does is they say, okay, we want to borrow some money. Anyone, it depends on how exactly they issue the debt. It depends on who's allowed to buy it. But there are some forms of government debt that you and I can buy. So if we want to lend money to the Canadian government, we can do that. We lend it. We get a certificate that says that we lent it. And, in 5 years, 10 years, 20 years, we get it back, the amount that we lent, plus we get interest on it. And that interest rate is specified. And so that product, that financial product, is called a bond. Okay, so a bond is something that's issued by the government, basically a form of debt. And it's just a certificate that basically says they're going to repay it at some point in the future. And you're going to get some interest on it as well. And because we saw in the last lecture that there's mild inflation, you obviously want interest. Otherwise, you're going to because of inflation, you're going to end up getting the same number value back, but it will be worth less. Okay, so you want some interest rate. So the Treasury borrows money, say from the banks or anyone who basically wants to buy them, and then they issue these certificates. And so a bond is basically just a certificate that says someone lent the government money, and whoever shows up with this bond, so I can lend money to the government, but then I can transfer that to you, so you become the person that the government repays instead of me. Okay, and you pay me to become that person. So these bonds are like a transferable asset. There's something that you can send. Okay, so the central bank likes bonds, but they can buy anything here, and there's a modern movement called quantitative easing, which is basically buying up assets that aren't necessarily from the government. Bonds are considered very safe, right? It's a safe loan because the government is going to be around and solvent in 10 years or 20 years probably, right? With almost 100% certainty, and so you will get your money back. Okay, so that's the thought. So what the central bank does is they don't just print money. What they do is they have to buy an asset in return. So what they do is they go out and they create new money. So the checking account of a bank goes up, but the bank has to send a bond back. And so the bank didn't make money on this transfer. All they did is they converted cash into bonds. And the central bank also, they didn't enrich themselves by printing new money because they had to give it to someone else and they got back a bond instead. Okay, so the way the central bank works, actually, I'm going to backtrack on that. The central bank did kind of enrich themselves because they didn't have the money to buy that bond in the first place. Okay, so it looks like it does actually look. Let's go to the heart of it. So it does look like they're printing money. So they're printing money, and they're not making the banks any richer because they're at least getting something back in return. But isn't the central bank themselves getting richer, right? Because they don't have any money to go out and buy bonds, so they just print it. Right now they have a bond, so they're 10 bonds richer than they were before, and they did that by just printing money. Okay, but the way the central bank works is that for all the money that they print, they're obligated to basically repay it. Okay, and so the way it works is it's less like a printing press, and it's more like, I think of it as a library. And the money library might have the printing press in it. Okay. But what a central bank is their sort of obligation is when they need new money, they borrow it. Not in a lending sense. They just sign it out. Okay, they go to the library and say, I need some money, and the library prints it and says, okay, here you go. But you do have to pay it back. Okay, we want it back eventually. So what will eventually happen is that these bonds will expire. And so the central bank will go back to the Treasury and say, okay, I have this bond. And the Treasury will say, okay, here's your money plus your interest. And then the central bank can go and it can return the money to the money library. Okay, so it didn't necessarily make or lose any money. Okay, it depends on the performance of the bonds and things like that. But it's meant to be largely neutral in this case. Okay, so it's buying something of value with the newly printed money. And that the thing that it's buying is something that will eventually turn back into cash. And when it turns back into cash, it basically gives the cash back. It takes it back out of circulation with it. Okay. Now, banks will never fully take all the cash out of circulation, so they always maintain a certain amount, and they do that basically to maintain the economy. So what they want to do is they want to make sure that interest rates are stable, inflation stable, and things like that. And so you might say, well, why do they decide to go out and buy bonds? And what you hear on the news is something like, the central bank is dropping interest rates by 0.5%, right? Or they're raising interest rates to 1%. That's what you hear on the news. And they're not literally setting rates, okay? Because they can't. Rates are decided by banks. Banks decide, they'll lend at whatever rate is most profitable and when they can, get people that actually want to borrow. So they have no direct control. They can't just say the interest rates need to be X. So what they do is they use this mechanism of buying money or buying bonds in order to influence it. So if they buy a bunch of bonds, what they're doing is they're increasing the amount of money that's in the economy. Okay, and when the amount of money goes up, then money's cheap, and it's easier to get a loan. And so interest rates tend to go down, right? These banks are sitting on large piles of money. They want to put it to work and earn some interest. And so they're competing to find people to borrow the money from them because they have extra money. So when the bank goes out and they buy these bonds, it tends to flood the system with money, and that makes the loans, the interest rate on loans go down. It starts on interbank loans, so banks lending to each other, and then it kind of spreads from there to the interest rates that you might get from the bank on your mortgage or on a car payment from a lease company or something like that. Okay. Now the central bank can do the opposite. Okay. So the central bank might say, hey, I want to sell some bonds. Okay. So they often will do this as well. They'll say, I have some bonds and I want to get some money back. Okay. And when they get the money back, then they can return it to the money library. Okay. So they don't have to hold the bond until it expires and then get the money back from the treasury. At any time, they could go back in the market and say, okay, I a while ago I bought a bunch of bonds out of the market and now I want to sell them. Okay. And what this will do is it will decrease the amount of money in circulation. Okay. Usually they give a really good rate. So the banks are really eager to buy these bonds. They're usually cheaper than they could get otherwise. And so they'll buy up the bonds and they're going to use cash in order to do it. So now they have less cash available. They have a whole bunch of bonds available. So they're not, they still are worth the same amount of money. Okay. The banks aren't getting richer or poorer. They have a different kind of, their capital is in bonds as opposed to cash. Okay. But now, because there's not a lot of cash, it's harder to get a loan because no one has excess cash, right? They have just enough cash that they need, and no one has extra. And so if you want to borrow, then they would have to go and sell the bonds to someone else because the government's selling, they're not buying. And so they, somehow they would have to, they'd have to get cash some other way. Okay. So loans become expensive, which means that interest rates go up. Okay. And so, this is the mechanism basically that they use if they want to increase interest rates. And this is the mechanism they use if they want to decrease. Okay. This is the mechanism where sometimes you hear the term like they grow the central bank's balance sheet. We won't go into what balance sheets are, but that's basically what's happening here. And when they take money out of circulation, then they reduce their balance sheet. So that's basically, almost everything a central bank does, at least that you hear on the news. You're like, okay, Bank of Canada announced the new interest rate and it's going up, it's going down, or it's going up. Well, they're going and they're doing these operations, or the bank is trying to grow their balance sheet. Well, then they're trying to create more money in circulation. If they're reducing it, then they're trying to cash these bonds in and get money back. In order to reduce their balance sheet. So those are the basic things that you do. The whole thing is called open market operations because they're not setting interest rates literally. They're influencing interest rates by buying and selling bonds in the open market. Okay, so that's it. That was a bit of a quick, whirlwind tour of how central banking works. But I think it's important to understand it at least a little bit, especially if you're going to interact with people that are. When you look at stablecoins and how they work, you can think about it. You can think about how this compares to Bitcoin. You can think about whether you like this model or not. There's a lot of people who are into cryptocurrencies because they do not like this model. And then you have a lot of more institutional people who like this model. They accept it, but they see Bitcoin and cryptocurrencies as offering some alternative that might be safer in some regards, or less safe. And then there's some people that say, when central banks go out and they buy bonds, what if they go out and buy Bitcoin instead, right? You could still do open market operations and influence interest rates that way if banks hold cryptocurrencies, right? So should central banks hold cryptocurrencies? They don't just hold bonds. They might buy a shopping mall, or they might buy kind of like bonds, but not from the government, from other companies. It's called commercial paper. And there are some central banks. They tend to be like kind of smaller ones who are actually going out and getting cryptocurrency, and they're holding it. So anyway, so these are some interesting things to think about, at least.